Welcome back. Today we're going to unravel one of the most mysterious and fundamental aspects of our economy. How is money created? It's a question that often goes unnoticed, yet its impact affects each and every one of us. So grab your pens and paper because we're about to dive into the fascinating world of money creation. Before we understand how money is created, let's take a moment to ponder over what money really is. At its core, money is simply a medium of exchange that facilitates trade and economic transactions. But have you ever wondered where it comes from? To begin, let's briefly define the different forms of money that exist in the modern world. There are two primary types: physical cash like coins and banknotes, and digital or electronic money, which includes bank deposits and digital currencies. Now, let's move on to the intriguing process of how money is actually created. At the heart of money creation lies the relationship between the central bank and commercial banks. The central bank, often referred to as the lender of last resort, plays a crucial role in controlling the money supply in the economy. It monitors economic conditions, inflation rates, and takes actions to stabilize the financial systems. On the other hand, we have commercial banks, the ones most of us interact with daily. They provide services like savings and checking accounts, loans and mortgages. But did you know that commercial banks have a unique ability to create money? Here's where it gets interesting. Let's say you decide to take out a loan from your local bank to buy a new car or start a business. When you sign that loan agreement, magic happens. Well, not literally, but it might feel like it. The bank creates new money right at that moment. You see, banks are only required to hold a fraction of the total deposits they receive as reserves, which is typically set by the central bank. This is called the reserve requirement. The rest of the deposited money is considered excess reserves. Now, brace yourself for the fascinating concept. When a bank issues a loan, it doesn't take the money from its existing reserves. Instead, it creates the money out of thin air by adding the loan amount to your account. New money has just been created. As you can imagine, the ability of commercial banks to create money has a significant impact on the overall economy. It affects interest rates, inflation, and even the stability of the financial system. When banks create money through loans, it increases the money supply in the economy. This can lead to more spending, investment, and economic growth. However, if not managed carefully, it could also lead to inflation, as more money chases the same amount of goods and services. On the other hand, during times of economic crisis or uncertainty, central banks might intervene to reduce the money supply to control inflation or stabilize the currency. This is often done by adjusting interest rates or buying back government bonds. And there you have it, the intriguing process of money creation. Next time you use your credit card, make a deposit, or apply for a loan, remember the intricate relationship between central banks and commercial banks that drives the financial marvel. If you found this video helpful, be sure to give it a thumbs up, subscribe to the channel for more valuable content. Consider joining the channel by clicking the join button. It costs less than a cup of coffee, and get access to extra perks. Support us on Patreon, link in description. And don't forget to share your own financial goals or any additional tips you have in the comments below. Until next time, happy goal setting. Okay gladiators, let's make some money.